Welcome back to the deep dive. This is where we take a whole stack of source material, we cut through the noise, and really just pull out the concentrated knowledge you need.
Yeah.
And today we are zeroing in on a really critical 7-day stretch, December 9th through the 15th, 2025.
And this wasn't just, another week in digital assets. This was the week. This was a definitive turning point from, let's say, tentative exploration to full-blown institutional integration.
Right.
We've gone through all the top news stories you sent over, and our mission today is really to distill the core nuggets. What did U.S. regulators actually finalize? How did Wall Street respond? And what does it all mean for the market right now?
The themes were they were overwhelming, but they all point in one direction. We saw the big U.S. federal regulators, the OCC, the CFTC, and even the SEC, all making definitive moves.
Providing that clarity everyone's been waiting for.
Exactly. And that regulatory green light, it immediately triggered a wave of institutional products. We saw BlackRock's next big filing and a very, very interesting global scramble for new capital.
What you're hearing in these sources, it's basically the sound of the structural foundation being poured. And not just poured, but reinforced and connected to the existing global financial system.
That's a great way to put it.
I really think when we look back on the history of this whole asset class, this specific week will be seen as the moment digital assets moved from the economic fringe right into the core financial structure.
Okay, let's unpack this then. And we have to start with the big one. Regulatory acceptance. For years, the industry's biggest headache has been the lack of clear rules. But this week, regulators didn't just offer suggestions. They carved out specific federally regulated paths for the biggest players.
The foundational story, and there's no doubt about this, came from the U.S. Office of the Comptroller of the Currency, the OCC.
And just for anyone who doesn't know, this is the Treasury Department Bureau that regulates all the U.S. national banks. A very big deal.
A very big deal. And they conditionally approved National Trust Bank charter applications for 5 just massive digital asset firms.
And the names are the backbone of the industry, too. We're talking BitGo, Fidelity Digital Assets, Paxos, Circle, and Ripple. But let's pause on that. What does getting a National Trust Bank charter actually unlock for these firms? What's different now?
It's a total game changer. It allows them to operate under a single, unified federal license across all state lines.
So no more state-by-state patchwork.
Exactly. That whole system was complex, it was expensive, it was unstable. Now the U.S. banking system is effectively saying, we see you. You are serious regulated entities. It means for you, for the listener, that the platforms you rely on are moving toward the same safety standards as traditional banks. That dramatically improves long-term confidence.
So while the OCC was paving the way for institutions, the SEC, kind of surprisingly, was focusing on the retail investor, on you. They put out a new investor bulletin on December 12th about how to hold crypto safely.
And their focus was incredibly specific. It was all about security fundamentals. They really hammered home the importance of storing and accessing your private keys.
Yeah.
That's the string of code that actually proves you own your crypto.
Right. They even got into the difference between a hot wallet, which is, connected to the internet.
Convenient but risky.
And a cold wallet, which is offline and much more secure.
Yeah.
But wait a second. If the SEC is warning everyone about holding their own keys and the risks of, third-party custodians, doesn't that sort of contradict the whole institutional narrative? BlackRock, Fidelity, they rely on huge custodians for their ETFs.
That is a fantastic point. It really highlights the regulatory tension here. The SEC is trying to balance 2 opposing goals. On one hand, they're enabling these huge institutional inflows, which had to have third-party custody. But on the other, they're trying to protect this new wave of retail money that might not get the risks involved with those same custodians. It's really an act of due diligence. A reminder that if you choose to self-custody, which is the original crypto ethos, you have to be incredibly careful.
Okay, so if the OCC charters were the foundation and the SEC bulletin was the cautionary note, then the real power signal for institutional trust came from the CFTC, the Commodity Futures Trading Commission.
Yes. They launched a pilot program that fundamentally changes the derivatives landscape.
This is where it gets really important.
This is where digital assets get fully embedded into Wall Street's plumbing. The program lets Bitcoin, Ethereum, and USDC be used as compliant margin in regulated derivatives markets.
Let's break that down. We know what those assets are, but why does using them as margin matter so much to a bank or a hedge fund?
A word margin is everything. In the derivatives world, Futures, swaps, options margin is just collateral. It's the deposit you need to cover potential losses. And historically, only the most stable, liquid, regulated assets like U.S. Treasuries or cash could be used. By allowing BTC, ETH, and USDC in this pilot, the CFTC is basically classifying them as financially mature assets. Good enough for the big leagues.
That's a massive step toward legitimacy, isn't it? It means these institutions can be way more capital efficient.
That's it, exactly. Instead of having to post dollar cash, they can use their existing crypto holdings. It frees up capital. It dramatically lowers the hurdle for traditional finance to get fully involved.
So it moves them beyond just speculating on price.
And into real capital management.
Yeah.
The CFTC is validating these not just as things to trade, but as reliable systemic tools.
So that structural green light from DC, it prompted an immediate reaction on Wall Street. We go straight from regulatory approvals to institutional product filings.
And if there's one company that knows how to monetize a regulatory pathway, it's BlackRock.
Absolutely. The biggest product news of the week was BlackRock filing for an iShares Staked Ethereum Trust ETF. We're all used to the spot ETFs, but staking, that adds a whole new dimension.
It's a major strategic move.
Yeah.
Shows a new level of sophistication.
Yeah.
They are pushing beyond just buying and holding the asset.
Right.
They're moving directly into participating in the Ethereum staking ecosystem. For anyone who doesn't know, staking is basically locking up your ETH to help secure the network, and for doing that, you earn a yield.
So BlackRock isn't just offering you exposure to the price of ETH. They're offering an income-generating product built on Ethereum's own mechanics.
Precisely. And that changes the fundamental nature of how institutions engage. It means their capital is now actively participating in securing the network itself. It also, and this is important, it forces the SEC's hand on how they view these yield-generating products.
And the infrastructure needed to support all this is being built out globally, too. We saw a huge partnership between the British banking giant, Standard Chartered, and Coinbase.
Their goal was stated in plain English: build institutional crypto rails. You have this colossal traditional bank leveraging Coinbase's expertise in custody and execution. This isn't about small retail trades. This is about building the high-speed, compliant tracks needed to move massive amounts of regulated digital capital.
And it's not just a US and UK story. The sources showed massive European retail adoption happening at the same time. The French banking giant BPCE launched crypto trading for its 2 million retail clients.
That's a huge mainstream move. They immediately supported Bitcoin, Ethereum, Solana, and USD Coin. It just shows that institutional comfort isn't only about hedge funds and derivatives. It's also about serving the everyday customer in a compliant, bank-integrated way.
So we have all this incredibly positive global news, regulatory clarity, huge partnerships, BlackRock innovating. You'd expect the market to just take off.
You would think.
But that brings us to our third section, the reality check of market volatility.
Indeed. Despite all those monumental tailwinds, Bitcoin took a sharp, short-term dive that was a real gut punch for many.
It actually dipped below its year opening value of $93,507. It erased its gains for the entire year, just for a moment. That kind of reversal, with such good news, it's startling.
It really reinforces a key lesson. External macroeconomic factors can still dominate short-term price, even when the fundamental news is fantastic.
So what were the factors?
The sources cited two main things: aggressive profit-taking after a long run-up, and just general macro uncertainty, probably tied to global interest rate decisions. The institutional buy-in gives you long-term confidence, but the day-to-day is still ruled by shorter-term sentiment.
A classic disconnect between fundamentals and price. But what's interesting is that not all assets reacted the same way. While Bitcoin struggled, Ethereum showed surprising resilience.
The technical outlook was very clear on that. ETH showed the strongest short-term recovery during the week. And if you connect that back to what we were just saying, that BlackRock Staked ETH ETF filing almost certainly provided a powerful support narrative.
That vote of confidence insulated it a bit from the macro jitters.
I think so. It likely did.
And speaking of global dynamics, while the U.S. was formalizing its rules, crypto leaders were physically on the move, looking for fresh liquidity.
We saw this massive flurry of executives gathering in Abu Dhabi. The goal wasn't just networking. It was an aggressive search for deals, for capital, from deep-pocketed Emirati investors.
It just shows how strategic the industry is. When Western liquidity gets tight or markets are uncertain, the sovereign wealth funds and private capital in the Middle East become this essential target to inject new vigor.
And while the West and the Middle East were trading and making deals, Asia was making moves toward greater transparency. Hong Kong announced plans to implement a new crypto asset reporting framework.
And this is more than just a local rule, right? This framework, CARF, it came from the OECD. What does it mean for Hong Kong to adopt this standard?
It's vital. CARF basically requires financial institutions to automatically share info on crypto transactions with tax authorities and other participating countries. Hong Kong adopting this shows a deep commitment to aligning with global standards.
So it's not just about allowing crypto.
No, it's about regulating it responsibly. It cements Hong Kong's role as a major, compliant, global player in this space.
So if we pull all the way back and look at that whole week, it was just dominated by this overwhelming regulatory progress and institutional integration. The OCC charters for firms like Circle, the CMCC accepting BTC and ETH as collateral.
And, of course, the BlackRock filing. The biggest players have formally engaged. The pathways are now crystal clear. The structure isn't just being talked about anymore. It's being built brick by regulatory brick.
What's so fascinating, though, is the market's almost violent reaction, that big price dip, even with all that positive long-term news.
Exactly.
And that really raises the ultimate question for you, the listener, to think about. We've seen global regulators in the U.S. and Hong Kong formalizing access. We've seen massive institutional capital starting to enter the market.
So considering the sheer volume and I suppose the stability of this new regulated money, how is it going to impact the kind of short-term volatility we just saw this week from profit-taking and macro fears?
Is this institutional wave finally big enough and steady enough to smooth out those wild retail dips that have defined every market cycle before this? Or are those macro forces just still too powerful?
That's the defining question for the next era of digital asset markets.
A deep dive for another time. For now, you can find all the definitive source materials we referenced today in the notes for this deep dive.
Thank you for joining us. We hope this knowledge helps you understand not just what happened, but why it matters for what's coming next.